Welcome back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. Thank you for staying with us on CNBC-TV18. We wake up this morning in just about 15 minutes from now. We'll get the opening rates for the day, and looks like it's going to be a muted start. Dipan Mehta is still sitting by with us. Dipan, I wanted your thoughts on the auto sales that came through yesterday. The big takeaway for me was that commercial vehicles have done very well, both Ashok Leyland and Tata Motors, and premium SUVs as well as electric vehicles have done well. Within that piece, any stocks that you like?
Yeah, Sonia, I think one of the negatives was the two-wheelers. So that certainly is a cause for concern that now clearly they are getting disrupted by the new generation electric vehicle scooter companies because the likes of Ather and Ola Electric also have done pretty well. I believe Ola Electric sold 25,000 units. So that's one concern area. And yes, you're right. I think commercial vehicles, tractors did pretty well. But I think the clear winner has to be M&M. And they continue to build on the solid foundation which they created over the past 2-3 years. And the success of their models is clearly playing out. A bit disappointed with Maruti's numbers, but then they got new model launches coming up in the next few weeks or so. And that certainly could boost the sales. So within the auto space, it's best to remain with all the four-wheelers, commercial, passenger vehicle or tractors, and avoid the two-wheelers with the perhaps exception of Eicher Motors, which is in a different league by itself.
Okay, just to add, how are you placed on TAMU with all this conversation, chat about China recovery?
It's a very complicated company, Tata Motors. It's not just India business, it's Jaguar Land Rover, which is again a complex business with UK and US and Europe and China. And while China does well, you see what's happening in UK markets as well as Europe and US. So it's a very confusing signal. And you have such excellent choices in the auto space with M&M and Maruti and Ashok Leyland. I think why you want to get into something which is so complicated. And there's a great deal of uncertainty as to how their earnings will play out over the next few years or so.
Okay. Do stay on. We have to come back to you for another stock, which Vivek is going to analyze for us in our Momentumizers segment. Vivek, you have NCC on your radar?
That's right. So after a long time, we actually have a name from the infrastructure space that we are highlighting. The stock yesterday ended very sharply higher, almost 9% higher, and on good delivery percentage as well, 22% delivery volumes is what we saw. Now, just in the last 6 to 7 trading sessions, the stock has been continuously moving higher, almost 18% higher in the last 6 trading sessions. So what was the trigger yesterday? The company went ahead and announced the order wins that it had secured for the month of December. So almost 3,600 crore worth of order wins, and this was from mainly state governments and across all of the segments that they were present in, that is the water, electrical, as well as irrigation divisions. On the back of that, a lot of brokerages have come out with notes. In fact, DAM Capital believes that this is the preferred infra pick. They have a buy rating on the stock. They believe at 8 times FY25, estimated earnings, this is quite attractive valuations for NCC. Yes, securities too believe that at this rate, NCC, using its strong execution capabilities, can be leveraged, and it will continue to benefit from increased awarding momentum as far as ordering is concerned.
Okay, thanks a lot for that. So that's on NCC. Dipan, any thoughts? I mean, we've spoken about, of course, the infrastructure piece as a whole, but on NCC particularly, do you like it?
Yeah, absolutely. I think, Sonia, and by and large, when the entire sector was going through a crisis phase, NCC was pretty much, holding on over there. And they did not go ahead and invest heavily into projects which they had to operate and finance themselves. And now that the scenario for the sector has improved, I think they're reaping in the benefits of very large order inflows. Very strong in the southern region, especially Andhra, Telangana. And that's a lot of development is going to take place. Very good execution capabilities as well, and attractively valued with a lot of scope to increase its operating revenues and operating leverage and even the valuation ratio. So very positive on NCC, as is the case with a lot of other engineering construction companies.
Okay, Deepan, finally, what would you do with the FMCG companies? Is there anything, or are they really richly valued?
Well, Lata, I think that FMCG now is a mature industry, and you won't get those 20% type of earnings growth which is required for creating outperformance in your portfolio. But consumption in India is strong, and you go for new FMCG businesses, new consumer-oriented businesses like QSR, travel, hospitality, healthcare, entertainment. I think these are the new sectors, retail especially, like specialty retail companies as well. I think all of these have the potential to grow at mid-teens or so and create great deal of value and fantastic runway for growth as well. On the other hand, FMCG is, I think, fairly valued and volume growths are single digit, low single digit, and that doesn't really interest investors who want to create a lot of value and outperformance in their portfolios per se.
So chase the premium consumer is the name of the game, is it? Thank you very much, Deepan, for an enlightening chat and for bringing us up to speed with trading. Meanwhile, the pre-opening rates are hitting the screen, and it's not all that muted actually. Nothing as bad as what the SGX Nifty indicated. I mean, SGX Nifty itself was just about 0.25% lower, but we're doing a little better than that at this point in time. It's largely a flat opening. So let's go over to the segment that was the vanguard yesterday, Nigel?
Absolutely. Well, metals were in focus yesterday. We saw ferrous and non-ferrous stocks do well. In fact, ferrous did a tad bit better. What should you do from here on? Well, to help us out with that, we have Aditya Walekar, Senior Research Analyst at Axis Securities, who joins us. Hi, Aditya. Thanks so much for joining in. Good morning to you. Well, yesterday we had a good run. Now the street is divided. This is the actual thing, and this is the real deal. So to hang on to your positions. The flip side is, maybe in fact it's giving you a good bounce, and the globe could still go into recession. So book out of your position. What's your sense on the steel stocks first up?
Thank you, Nigel. So good morning. Well, I think there are a couple of things. Number one is that the iron ore prices are rising in China. That is mostly due to the restocking ahead of the Lunar New Year holiday in China. So that is supporting the steel prices in China. And number two, the margins in Chinese steel mills, they are at a low level. So that is also supporting the steel prices. And of course, China reopening, that is building a positive sentiment overall. So based on these, if you see the Chinese HRC prices have rallied, and currently yesterday they were at $605 per ton from the low of 515 in November last week. So based on that, currently if you see the Indian steel prices are at now discount to the Chinese imported prices. So the Indian steel prices definitely have well support at this level. Coming to, we stick to quality names like Tata Steel. So based on this run up in iron ore prices, Tata Steel Indian operations are integrated with respect to iron ore. So also the valuations are attractive, and there is some upward room left for Tata Steel from this level. If you see, it's currently trading at a price to book of 1.06x, and at the peak of the cycle, it can go to 1.5x. So there is still some upside potential left for Tata Steel. Okay. And post,
what, Aditya, what about SAIL? They also have iron ore.
SAIL also has iron ore, but SAIL has certain legacy issues, especially their return on capex is so far not been very attractive, and their cost of operations are slightly sticky and sensitive to coking coal prices. So no one can predict what will happen to coking coal prices. Currently, they are stable and in the range of $280 to $290 per ton. But SAIL being more sensitive to cost and coking coal, we prefer Tata Steel over SAIL, and maybe we can see some upside in SAIL if the sentiments builds up and China's property sector really turns out and churns out good numbers. Then maybe SAIL can also rally, but maybe
you prefer
Tata Steel over SAIL.
Yeah. Got that. Okay, got that. In any case, SAIL is down almost 17% in the last 12 months. Tata Steel has seen a big outperformance. What about Hindalco? The valuation seemed to be reasonable at about 1.1 times price to book forward. But the expectation is that Novelis margins are likely to worsen in the second half of the year. Would that be a concern for you?
Yeah, so for Hindalco, management has already stated that in H2 FY23 the Novelis margins will be impacted, and but from FY24 onwards, the margins should pull back to $525 per ton. That is their long-term sustainable EBITDA per ton guidance. In H2, they have primarily cited about the higher coal energy cost and logistic cost. these issues will get ironed out, and from FY24 we expect that Novelis will again pull back and will get back to its $525 per ton EBITDA guidance. And also its upstream aluminum business, the costs at upstream aluminum business are likely to peak out, the coal cost. So, and its copper segment is also expected to do well. So based on that, Hindalco is also has upside potential from even at this level. Maybe once again at the peak of the cycle, it has gone to 1.5x price to book. For aluminium also, the tailwinds are US dollar is peaking out, and then China is opening. So aluminium is well placed. So currently at $2,350. So it can easily rise to $2,500 up to that level. So aluminum prices, aluminum prices have support of thermal coal.
All right. Aditya, at the peak of the cycle, some of these stocks, they traded 1.5 times, but at the bottom of the cycle, we have also seen them at around half or, 0.6 times price to book. But given that their balance sheets are in far better shape, maybe this time, even if things go wrong, maybe you'll find some better support and we don't go down to around half times price to book. Final question before we let you go. Aluminium, I think you mentioned are $2,500 per ton. So if you could give us, what is your estimate on aluminium prices as well as iron ore and coking coal for 2023?
So for 2023, we expect aluminium prices to trade in the range of 2,400 to 2,500. If the things work out, it may trade at a higher level of near 2,500. For iron ore, we have seen the rally for iron ore recently, so it may trade in the range of $115 to $120 per ton. And for coking coal, it's slightly difficult to predict because there are weather-related events from Australia. So that could drive the volatility in coking coal prices. But as of now, maybe $300 to $290 per ton guidance we can take.
All right. Thanks a lot. Pleasure speaking with you. Have a great day. The pre-opening rates are settling a tad bit lower, nothing alarming. The Nifty is down about 30 odd points. And on the upside, once again, it's metal stocks that are doing well. Tata Steel is your big gainer, up about half odd %. Sudarshan is back with us and Mitesh as well. Let's get some 9-10 calls going. Mitesh, what's the big call at 9-10?
I think I'll go with a buy on a short Leyland with a stop at 146 for targets of 155.
And Sudarshan, what about you?
If 18,100 holds, look to buy the Nifty. SBI Cards is a buy with a stop under 790.
Any view on Axis Bank, Sudarshan? I mean, it's just heading the charts on the Nifty today, but anything specific?
See, generally, private sector banks are probably likely to outperform. But Lata, that means they will do better than the Nifty. That's all. I can't say they will go up or down.
Okay, let's get Nimesh in now. He has the Standout brokerage report of the day. Nimesh, over to you.
Thanks, Vanessa. Today's Standout is on LIC. A big report from Kotak Institutional Equities. They've initiated a buy rating with a target price of 1,000 rupees, a potential 40% upside from current levels. They believe that LIC's dominance is unparalleled with a 37% AP market share in FY22. In fact, companies' high productivity versus the peers, remain bedrock for LIC's market dominance as well as cost leadership. The gradual shift in product mix should, boost the VNP growth going forward, despite moderate APE. In fact, the account bifurcation has led to increase in the embedded value and earnings, despite lower return on embedded value, that look little depressed. So, at current valuations, LIC they believe that it's attractively valued and it's ignoring the strengths, and hence they've initiated a buy rating with a target price of 1,000 rupees, a potential 40% upside on LIC from current levels.
Okay, a lot of investors will be happy, Nimesh. They had a very good IPO demand. Okay, the other stock that's doing well today is M&M, about over 1% higher. Abhishek is here to tell us what's working for this stock. Abhishek?
Well, Lata, M&M Financial has come out with their business update wherein they say that the disbursements for the month of December is about 4,650 crore, up about 3.3% month on month. So for Q3, calculation shows that disbursements are at 14,400 crore, up more than 80% YOY and more than 22% sequentially. So business assets or the loans have been at 77,000 crore, which is up 4.3% quarter on quarter and nearly 1% on a month basis. The best best part is that the asset quality continues to improve. So gross NP ratio is down to 6.2% when compared to 7% in the previous month, as well as 6.7% in the September month. So collection efficiency has improved for the month of December. It was at 98% when compared to around 96% for November, as well as 98% for September. So strong collection efficiency, improvement in asset quality is the key highlight from their business update. Back to you.
Okay, all right, Abhishek, thanks a lot for that. Well, hopping across to Mangala. Mangalam, another resignation at Zomato. Not great news.
Not great news for Zomato. The CTO, Gunjan Patidar, has resigned. Remember, Patidar was one of the first few employees of the company, so also has been given the co-founder status. At the same time, he's the one instrumental in building the core tech systems for the company. However, as the company scaled up, it'll be interesting to see, whether his impact would, with his exit, would be more or not, because these guys usually have tough systems. However, it does not, bode well when looked at in conjunction with the big exits that have happened from the company. I mean, you had co-founder Mohit Gupta resign, you had New Initiatives head Rahul Ganju resign, and Intercity Legends head Siddharth Zawar resign in just the last 3 months or so. Zomato's leadership now lies with 3 key people. We have Dipinder Goyal, Arbinder Dhinsa, as well as Rakesh Ranjan. So these are the people now to watch out for in Zomato.
Okay, thanks a lot for that. Well, the stock is under a bit of pressure now, down 2% in pre-opening. Sonal is with us to talk about the oil and gas space. Sonal, over to you.
Well, I'm focusing on some stocks, starting with ONGC, which will be in focus because the rig for the company, Sagar Samrat, has started oil and gas production in the Arabian Sea. And in terms of numbers, it will handle 20,000 barrels per day in terms of crude oil and expected to add 6,000 barrels per day of production to the rig in the coming days as well. The maximum gas export capacity by this rig will be 2.36 million cubic meters per day. This is about ONGC specific news. We also have revision of windfall taxes, and this time around they have been hiked on the back of rising crude prices. On crude petroleum production, it has been increased to 2,100 rupees per ton versus 1,700 rupees per ton. Export duty on diesel is increased to 6.5 rupees per litre. On petrol, it continues to remain nil, but on ATF, it has seen a sharp hike from 1.5 rupees per litre to 4.5 rupees per litre. So it could be negative for the likes of Reliance Industries and Oil India as well.
All right, thanks a lot for that. We have about 30 seconds left for the markets to open today, and the expectation is that the opening will be mildly in the red. The Nifty has been hanging on to key levels, the 100, the 200-day moving average, but for now, holding above the 18,160 mark. What could be on the upside once again today is the metal stock. So Tata Steel up almost about 0.5%, and that seems to be the order of the day. The first tick on the index is absolutely flat. The Nifty down about 20 odd points or so. Mid-caps and the Bank Nifty are actually in the green. So it's a fairly decent opening, you'd have to say, for the broader markets. The headline index is just consolidating around 18,170. What's leading from the front this morning is Tata Steel up about 0.5%, followed by a couple of other names in the metal space. You have SBI, SBI Life, Tata Consumer, Tech Mahindra, Kotak Mahindra Bank and IndusInd Bank that are also leading from the front this morning. A couple of other names like Divi's Labs, Dr. Reddy's are trending in the red, but not by a large amount really. In fact, it is consumption and pharma, which is under a bit of pressure. So in consumption, there's Britannia, HUL, that's down about 0.5%. In pharma, there's Sun Pharma, that's under a bit of pressure right now. A couple of other names, Infosys, TCS ahead of the earnings next week are under a bit of pressure. And you have something like a Hero MotoCorp, which has been sulking post its numbers. Asian Paints, M&M, Bharti Airtel are a couple of names in the red. But otherwise, it's a very quiet opening, you'd have to say. Just down about 20 odd points for the Nifty, holding at that 18,150 level.
Actually, Sonia, the backdrop has changed. Over the past hour, the KOSPI, which was about nearly 2% lower in early morning trade, at its worst it was about 1.8% lower, is now only 0.5% lower. There's a decent recovery in KOSPI and a couple of other Asian markets as well. And the pre-opening rates, which were pre-opening US rates, the first curb trades that we got were mildly in the red, now they're mildly in the green. So it looks like the world is not opening, and the Indian markets are not opening to too much of global headwinds at this point.
Right. Let's do a quick check on all those mid-cap stocks that are moving around. A couple of resignations. The street doesn't like that. Zomato is under some pressure. The CTO and co-founder Gunjan Patidar resigned, so that stock is down close to 3.5%. Birla soft as well. You had the CFO that resigned out there, so that stock is opened up with a negative tick. of close to around 1%. The operational updates actually coming from the banking and financial names, they were pretty good, and that's why the street is reacting to that. Mahindra & Mahindra Financial Services, South Indian Bank, and CSB. All those three stocks, well, they have opened up well in the green. PSP projects, well, they have emerged as the lowest bidder for a government project in Surat, that's in Gujarat. 1,300 crore order, and the street likes that. The stock is up close to around 4% odd. Pyramid Pharma, yesterday we saw some traction on ground. Well, the stock has been a big underperformer. But this morning, Jefferies, well, they have initiated coverage with a target price of around 150 rupees odd. They believe that most of those headwinds, well, they are getting behind them. And in the next few months, they're anticipating that they can grow in double digits, as well as the EBITDA performance can improve sharply. And that's why that's up close to around 3% or thereabouts. All in all, the Nifty is open up with a cut of around 30 points, but heartening to say, yet again, the breadth of the market is in favor of the number of stocks advancing. Volumes will gradually pick up, but good to see more number of stocks advancing than declining.
All right. Well, we have Sridhar Shivram, Investment Director at Inam Holdings, who's joining us right here in the studio. Sridhar, Happy New Year to you, and hope this year is filled with not just health, wealth, but a lot of travel for you.
Yes.
To newer destinations, to richer
Happy
forests.
New Year to everybody.
And better sightings as well for you.
I was going to say that.
I don't care about sightings. As long as I'm in the jungle, I'm always happy. I get new ideas there.
So you're back from a jungle now. Tell us, what are the new ideas for 2023?
Well, the idea is not to have FOMO and just stay put. Our view for 22 was it's a tough year. I don't think it's changed much for 23. That macroeconomic data still not looking very favorable for a global bull market. So this is going to be another challenging year. Like we saw in 22, we'll see a lot of ups and downs, at least for the first 6 months. That's our view, at least that's my view. That's better to protect capital again in the first 6 months and take a call post that.
You know, it's at such times that alpha managers become important, because it's not going to be a top-down market.
So actually, last year was a great year if you had the right stocks. And fortunately for us, we were more in the value camp than on the growth camp getting into 22. And we thought that, end of 21 was like the peak of growth. Buy anything, PE to concept and PE to some nonsense. Just couldn't understand, and I had seen all this in 2000, and I could actually see a repeat of that in front of me. So fortunately, the mistakes I made in 2000, I didn't make in 21 and 22. So the experience of managing money over a period did help. But I think a lot of the froth is out. But does it mean that the macroeconomic environment looks great? It doesn't. But there is opportunity to make money. So there are pockets where you can still make money. But you have to tread carefully. You have to be sure that earnings growth or your outlook on the earnings on these stocks are good. And there are some margin for error. But if your margin for error is very high, markets punish very fast, as we've seen.
All right, Sridhar, let's focus on the two pillars of the market then. Banks, which you have been positive on.
Sure.
But some of them have seen a big run. So what's your view for 2023? And IT, that's the other pillar that's been sulking. After having a very, very good 2021, we did see a bit of a downtake. Have they come to levels that you like to get in, or do you believe still stay away? There'll be a deeper correction coming in there.
So on the financials, our view remains that it's possibly on a sweet spot right now. Big bankers like Mr. Uday Kotak said it's a Cinderella moment, and I don't dispute that, because it's not just the loan growth. Actually, the bigger delta is the credit cost. When you speak to people in the banking sector, they tell you that it's not only the corporate sector which is not seeing the credit cost, even the retail, for whatever reason, strangely enough. In fact, our view is there's a K-shaped recovery. We should see retail NPAs coming through, because if the lower half is not, participating in the growth, then there should be NPAs there. But strangely enough, the bankers are telling us that even the NPAs in the retail segment are much lower than what they have modeled in their, books based on their assessment. And so they keep telling us, don't go with the credit cost we saw in the first 6 months. It'll be higher, but we're not seeing follow through of that. So whatever it is, I really don't have an exact answer. We think credit cost is going to be significantly lower. As a result, the earnings growth for banks will be significantly higher. As a result, we will see upgrades in financials. Maybe possibly the only sector where we think there is chance of an upgrade. In fact, we think there'll be downgrade opportunity or downgrade possibility in most of the sectors. So as a result, there could be earnings cut, but in financials, We're very bullish, not only in the private sector, even on the PSU. We've been champions of PSU banks almost for 2 years now. A lot of it is played out, but we think that a lot more will play out.
You're taking away my next question. Exactly that. Everyone's got ICICI and HDFC Bank and maybe even SBI. Lower down, we saw a spate of buys on BOB and even PNB started coming in. Would you go still lower in the PSU list and old private sector banks?
So Lata, I think what is happening is basically exactly what I said. The credit cost is lower. Mistakes the banks have made in the past 2-3 years are much lesser. So you have a Cinderella moment, almost as a rising tide takes all boats up. We would prefer to stay in select few PSU banks where we have more comfort, or maybe a few second rung banks. Is there opportunity in other banks when the the macro tailwind is so positive? I think a lot of the banks will do well. In fact, in one of your earlier shows, I had mentioned that just as a retail investor, you just buy a banking fund. That's it. You don't need to worry about which bank, what bank.
I remember, I think this was 2 years ago, we did a show on our Smart Money segment where I was talking to you about themes, and at that time PSU banks were out of favor completely. And I asked you repeatedly, are you sure you want to go with this theme? And you said, yes, I'm dead sure. And kudos to you for sticking your neck out at that time.
I'll tell you exactly the story that happened. I mean, this was November of 2020, and one of the investment bankers pushed us to a meeting with one of the PSU banks, and I said, I'm not going to buy PSU banks, so don't even offer me the meeting. They insisted, no, chairman is there, why don't you please meet? And it was a Zoom meet anyway, so it didn't matter. And as the meeting progressed, we realized that their pre-provision profit is larger than the market cap. So we said something is seriously wrong. So then we started looking at the other banks, and that's how this actually played out. And then we realized that there is a big story playing out. What happened after that, a lot of it is also that the macro environment has been favorable. We wouldn't have expected it to be so favorable. As I said, credit cost is much lower. I really don't have an answer for that, but it is much lower. So I think I stick to that theme right now.
Another theme I just wanted to ask you about, because it is the theme of the moment on the downside, is these new age tech companies, right? I mean, we're seeing a spate of large exits at names like Zomato. But the other way to look at it is profitability is improving, metrics are improving, and now the old guard is sort of moving out and fresh blood coming in. Would you read that as a good sign?
So I think we're starting to engage with a lot of these companies because a lot of the froth is out. We think growth will come back maybe in the second half. So we need to be ready with our analysis on which are the good companies and what is the right price to enter some of them, what is the business model, do they have a path to profitability. If a lot of this fits in, I'm not against any of the new age companies. Some of them are really good companies. Question is, what is the price we are paying for it? And I go back to my 2000 learning that Infosys and Wipro were trading at 50 times revenue. They were not bad companies. They were great companies. In fact, Z even today is lower than the price it was in 2000. So does it mean that Z was a bad company? No, we priced it wrongly. So that's the point, that these are great companies. Is the pricing right? In our view, no. Some of them are reaching the price. So we are still analyzing those. So I'm not against any of these. These are good companies, wrongly priced in 2022. Surely some of them are reaching good price levels.
All right. Sridhar, besides equity, suddenly we're talking about, fixed income. You're seeing yields go up there. They're becoming a little bit more attractive as well, which could be a risk to the flows that are coming into the equity markets. I wanted your view. There'll be a lot of our audience out there. They're looking to construct their portfolio. What should the asset allocation be? What about gold? Suddenly that started shining a little bit. Your take?
Yeah, so I'm a big bull on gold, and I've constantly told people that you should not look at the
Indian woman is the cleverest.
Yes, and I have stated that on Twitter, on my LinkedIn profile, that the best fund manager is the Indian woman, because gold has outperformed not only in the short term, in the medium term, even in the long term, the Sensex. So the Indian woman has shown, despite lot of people saying don't buy gold, our current account deficit is going up, it's a dead asset, but people fail to realize that it's a hedge against the currency.
But let me tell you that the Indian woman is also changing. There are two sitting here and both don't believe in buying gold. So
well, so there will,
because we have sons.
There will be exceptions.
As an investment,
but there will be exceptions. But majority of Indian women, especially women in the rural areas, the easiest thing for them to invest is gold, and they've been investing for years. But let's cut this. The net result is that gold has given double-digit returns, even if you take 15 years, 20 years, and has outperformed the Sensex in most of the periods. There are periods where Sensex has outperformed gold. But the point is in asset allocation, as you mentioned. In my view, 5 to 10% of your assets should be in gold, not because gold will outperform anything. It's just another asset class.
Yeah.
Plus, it's a hedge against the currency. If the currency depreciates 3-4% every year, the gold will give you that return anyway.
Sridhar, I'm actually
just
following...
this on asset allocation. When interest rates were rising 2004 to 2008, the market was also rising. And Greenspan told us that, accommodation will be removed at a modest pace. We knew those rate hikes were coming, but the markets kept rising. So is this rising rate such a big deal?
So, Lata, if you look at the global debt to GDP, what it was in 2003 to what we have now, it's like maybe
manifold.
Yeah, multifold. So we almost at 200 or 250% of global GDP.
Okay.
As a US consumer, if you think of their balance sheet, and when I speak to my friends and relatives in the US, it's not the fuel price that hurts them. It's the mortgage price that they have to pay, the interest rate that has gone up by 300 to 400 basis points. That eats into their, the surplus that they have. So I think the interest rates make a big difference. I think there'll be slowdown globally because of rising interest rates. So which is why I said that the macro, the factors macro are not really adding up right now for a global bull market. Forget an Indian bull market also.
Sorry, Nigel, you were...
No, I was just want to tell Sridhar that I'm following some of that advice. The gold sovereign bond, you get the 2.5% yield, or I'm taking care for my kids. Some kind of allocation.
It's a freebie the government is giving. You should always take whatever the government gives.
Absolutely.
They very rarely give you anything.
So we switched it around out here. 4 of us, 2 of us.
Give us one alpha idea. I mean, as you say, even if you can protect your principal this time, you will be lucky. But what would be, the optimistic trades?
So optimistic.
Banks only?
Financials is one. We're quite bullish on the entire defense space. So some of the stocks have moved up. There are a lot of other stocks. Some new listings have come in the last few months. The advantage of some of these companies who are doing offset. They're offset partners to international defense companies. So a lot of interesting themes playing out there. And the other thing is K-shaped recovery. The upper part of K is doing well. So if you can find companies in that space, some new listings have come specifically on that in the auto space. In general, anything which is on the premium luxury side is doing well. Real estate, you can add, even though they have some headwinds.
Indian
because
hotels,
of,
perhaps.
Yeah, any of those.
But we have a company now joining us, Blue Star.
Yes.
So I would request you to listen into that. It's also about consumption.
Sure.
And a lot of these players are indicating that the festive season is not as great as what one would have expected.
That's what I said. There'll be earnings downgrade across the board.
Yes.
So that's my point, that we are seeing slowdown when we speak to people or companies in general. The K part is doing well. So if you spoke to auto companies yesterday, the premium autos are doing well. The mass segment is
small
struggling.
car is
faltering. Yes.
So that K is playing out. So Indian markets will have a large part which is in the lower part of the K. Very small part of the earnings come from the upper part of the K. So we will see earnings downgrade, whichever way you cut it.
All right, Sridhar, always a pleasure
speaking
with you. Thanks a lot for joining
Thank
in
you.
and have great travels this year once
you very
again. Wish you the very best. But as we were saying, channel checks by several brokerages indicate that consumption has been declining post the festive period owing to the overall inflationary environment. Checks also exhibit that a large part of the pain is seen in smaller cities. So to get a ground check on how things are shaping up, B. Thiagarajan, the Managing Director at Blue Star, is joining in. Mr. Thiagarajan, good morning. As Mr. Sridhar was just mentioning, that there could be perhaps earnings downgrades as well because of the slump that we're seeing in demand and consumption. Can you quantify it for us? What is the kind of pain that we're looking at? And now with inflationary pressures, do you see further slowdown?
Good morning, Sonia. Happy New Year to you and your team and the audience. It's a pleasure talking to you. I do not see that in the segments in which we operate. So take room air conditioners. Given that the penetration is low, the segment continues to do well. The price increase has been there for the past 24 months. We have been increasing the prices, and there is no room for increasing the prices further. And the demand holds. I foresee it will continue to be so building up to the summer season. Despite even the energy label change, which normally pushes up the prices. On the B2B side, the commercial refrigeration continues to do well. Processed foods or pharma, these are the segments which are driving. And the infra segment, metro railway, data centers, manufacturing, the order book or order inflow is at record level. It continues to be so. You have to wait till January 31 for seeing the Q3 results as well. I would attribute that to the lower penetration in room air conditioners as well as commercial refrigeration. The capex cycle has begun, therefore B2B side, the order book continues to be good. Of course, there is margin pressure, but we have learned to live with that for now more than 9 months.
Okay. Good morning, Mr. Tyagarajan, and hope FY23, 2023 is a fabulous year for you and for everyone in your family and at Blue Star. You said that you'll learn to live with margins. So can you give us a ballpark of what you might do in terms of top line and bottom line growth? I mean, bottom line, can you even hit 500 crore?
I am not able to hear you clearly, Lata. There is some problem with the audio system.
Okay, okay. I was asking you if you can give us a good guess of how much your revenues and your bottom line may grow. Will your bottom line touch 500, 600 crore?
I will not jump to that. I would say the growth in the top line as well as bottom line should be more than 20%. That's what I expect. You have seen the trends during the past couple of quarters, and that trend will continue. And margin, you asked me that what did I mean by learn to live with that? We thought that the easing in commodity prices will improve the margins in the second half of the financial year. But then you have the rupee depreciation, which is offsetting the savings that you will achieve in the commodity prices. Having said that, Blue Star Climatech Limited, which is the Sri City plant, the new manufacturing unit from which Blue Star will source the products, it gives us some margin improvement. Basically, because it is located in South, both inward and outward logistics benefits are there. And the next thing is the scale itself is also going to help us improve the margins. So therefore, we continue to maintain throughout the year. The segment 1 between 6 to 6.5%, segment 2 8 to 8.5%. That will be the margin levels. You have seen in Q1 as well as Q2 these segments still, despite the commodity prices escalation, showing improved margins. So it is through certain other operating leverages, we will be able to maintain the margins.
Okay, all right. So, Mr. Tyagarajan, just to confirm that the UCP margins that you were guiding for 8 to 8.5% and an improvement from there on, you're sticking to that. I asked this in light of, Voltas, they've been sounding a little bit skittish on their margin outlook from here on. But you believe that 8.5% is pretty much on the cards, right?
It is on the cards.
Okay, all right. Also, price increases, I think you briefly mentioned that you are not looking to increase prices from January itself. The last time you told us you're looking at a review, so you're not increasing prices from January as well.
Not at all. So I did mention to you all that we will have a look at the prices once this quarter is over. We are not planning to increase. In any case, Nigel, what happens is for the summer season, new range of products get introduced. And these will be in line with our strategy. It is affordable premium range. We will go ahead and ensure the products are optimized for various markets and various segments. And therefore, there is no question of price increase from January 1.
Okay, okay. I also wanted to talk a little bit about the entry that you're looking at in the lower range premium segment in January. You were planning to do that for lower tier cities. How is the demand at the moment? What is the kind of growth that you see over there? And you were planning to increase your dealer network as well. So what will that look like over the next, say, 6 to 12 months?
You're absolutely right, Sonia. More than 67% of our sale come from tier 3, 4, 5 towns. Due to the good agricultural income, we are beginning to see surge in demand in the rural towns as well. We are all concerned about global slowdown, inflation and all, and I have not seen this kind of optimism in consumption in those towns at this point of time. So therefore, there are few things that are happening other than the products that are meant for them. Those segments, we are expanding the network, and I see multiple things happening there. There is the e-commerce which did badly. They are trying to do more in those markets as well. And we are looking forward to the implementation of ONGC. I think it will be a game changer because quite a few dealers will be able to directly participate in the e-commerce value chain. Similarly, quite a few e-commerce players are connecting to the distributors to reach the products to smaller towns. So therefore, the distribution architecture is undergoing a very massive change. And we are ahead of the curve there. We are doing quite a bit. Lastly, the marketing in terms of brand building in those markets.
Okay. Mr. Tyagarajan, when you last spoke to us, you said that because of the stop-start Chinese behavior, you all are, building up your inventory of inputs. Now that China seems to be off its zero-COVID policy, will that policy undergo a change? And will that be some of those cost optimizations that will help your margins?
I wish we are able to do that, but still the uncertainties are continuing there. Therefore, from the normal level of, say, 45 to 60 days, they are holding inventory of components between 90 to 100 days. This is continuing. And specifically at this juncture, it is quite uncertain. But the good news is that we are finding the factories working to full capacity there. And so there are no major concerns about disruption. At the same time, it is not giving us confidence to reduce the inventory holding at all.
Okay, all right. Mr. Tyagarajan, final question before we let you go. Competitive intensity in the room AC market has gone very, very high. I think it's the highest we've seen the last few years as well. Smaller players, larger players, everyone's grappling out there. You had given us a rough number that you're looking to increase your market share from year on. I think by the end of this year, 13.75%, and later on you want to take it to 15%. You believe this is still possible? And are you seeing some cooling off of this competitive intensity?
I would say the competitive intensity is stable as one can imagine. I think it is a healthy sign there is good competition. But our market share goal and the targets that we have indicated are intact. We will do that. We had indicated that by FY25, we will be a 15% market share player, and that's very much on.
Okay, all the best for your targets and thanks a lot for joining in. So order inflows continue to be at record levels. There's a 20% growth that they're looking at on the bottom line and top line, and a 15% market share is what they're targeting over the next
overall a very optimistic outlook. I mean, saying that in tier 2 cities, where is the slowdown?
All right, let's do one thing. Let's move to the cement sector now. After a short break, HM Bangur of Shree Cement will be joining in to talk about their outlook on the business and key trends that they're noticing.